sector. Here we are going to cover, so maybe I'll spend a few minutes initially talking about what has happened in the sector over the last 12 to 15 months and the way I see it going forward over the next year or two. Before that, let me just introduce myself. My name is Joseph George. I am the lead auto sector analyst at IIFL Institutional Equities. I've been with IIFL for the last 9 years, and it's been good going. So let me start with the view on the sector and preceded by what has happened in the sector over the last 12 to 15 months. So to give you a sector update overview, the downturn in the auto sector really started in August, September of 2018. It started because of a few things, few headwinds coming up at the same time. One with the increase in insurance costs for two-wheelers and cars. The on-road prices of vehicles went up. Second is towards the end of calendar 2018, there was the NBFC crisis, which resulted in problems securing loans for buying vehicles. This was more of an issue in cars and commercial vehicles. The third thing was that in calendar 2019, there were a lot of regulatory changes, because of which the prices of vehicles went up, because there were some safety norms which were introduced in case of two-wheelers. Features such as ABS, CBS came in, because of which the vehicle prices went up substantially. Even in case of cars, the airbag became mandatory, driver airbag became mandatory, ABS became mandatory. So because of all these issues, I'm coming closer. Is there a problem hearing me? Yeah, so I'm coming closer to the mic. So because of these various issues with respect to one, financing, second, increase in vehicle prices because of insurance and because of the safety norms, third, because the overall Indian economy went into a slowdown last year. So because of all these issues, the auto sector saw a big downturn in FY20. So two-wheelers and cars volumes were down 18% on a year-on-year basis. Heavy commercial vehicle volumes were down 43% on a year-on-year basis. On an average, sector volumes were down 20%. In fact, if I go back in time, if I look at volumes for the last 25 years, we have not seen a single year in which the average volumes across the sector, across various segments within the sector, were down 20%. So FY20, from that perspective, was the worst year that we have seen in the last 2 to 3 decades. And we also had one more headwind, which was the BS6 transition, which was due in April 2020. And because of this, vehicle prices were going to go up by 10 to 12%. Not so much in case of passenger vehicles, but high price increases in case of two-wheelers and commercial vehicles. And just as the industry was about to go past the BS6 transition, we saw another issue come in, which is COVID, and which is what all of us are facing right now. And as a result, what's happening is that on top of a very weak FY20, whereas I told you the average volume decline across segments within autos was about 20%, FY21 is likely to be a weak year as well. And so if I look at my forecast today, I'm building in about 15% volume decline in cars in FY21, 15% volume decline even in two-wheelers in FY21. In case of commercial vehicles, I'm building in a much sharper decline. I'm building in about 30% decline in FY21. And which means that if you look at FY21 volumes, which is the year in which we are right now, the volumes would be back by almost 10 years. So in case of passenger vehicles, that's cars, FY21 volumes would be back at FY11 levels. In case of heavy commercial vehicles, FY21 volumes would be lower than FY9, which was the global financial crisis. In case of two-wheelers, FY21 volumes would be almost the same level as FY14, which is back by about 7 years. Now, if I look at the if I look at the sector in this background, where auto volumes in FY21 is back by a decade. 10 years in case of cars, 7 to 8 years in case of two-wheelers, and about 12 years back in case of commercial vehicles. What it tells us is that the way forward, when I look at FY22, 23, I believe that we should see an extremely strong upcycle, because we have seen two very bad years. So last year -20%, this year would also be close to -20%. And from here, I think FY22, 23 should see extremely strong growth. Now, coming to the way forward. So one point, as I mentioned, is for the next 2 or 3 years, we should see extremely strong growth after 2 years of down cycle. At the same time, investors do care about what exactly is happening on the ground today. So let me just give you some feedback on what is happening on the ground. One is with respect to whether production is happening. Second is with respect to sales channels, whether the dealerships etc. are open. And the third point is with respect to the end demand. So let me just take it one by one. So if I look at production, most of the OEMs have announced that they have opened most of their plants. However, there are issues with respect to social distancing norms on the factory premises. So that is something that OEMs are still trying to get over. The second issue is that a lot of vendors, so for example, if you look at a car, there are thousands of parts that go into a car. There are several vendors who are located in containment zones. Because of that, the vendors have not been able to scale up production of the minor components that they make. And as a result, the OEMs are facing issues. So the first issue is with respect to social distancing norms on the factory platform. Second issue is with respect to obtaining parts from the vendors, because vendors have not been able to ramp up production. And the third issue that OEMs are facing is with respect to labor, because I'm sure you would have followed the headlines about a lot of migrant laborers who work as temporary workers in the OEM factories or in the vendor factories. Many of these, I mean, a majority of these laborers have gone back into their to their villages, because of which, if OEMs and vendors try to commence production at full level, at 100% level currently, there are issues, because labor availability is an issue. So the current situation is that production is impacted because of the three things that I talked about. The second issue is that not all the dealers have been able to open up. Many of the dealerships are located in bigger cities, cities like Mumbai, Chennai, Delhi, etc., where the lockdown is still prevalent to some extent. And the top 10 cities, in case of cars, account for almost 40% of the sales. So because of this, many of the dealerships are still closed. Even where dealerships have opened up in tier 2, tier 3 cities or in rural areas, the walk-ins of customers, etc., is not gone back to 100%. So we still have some time there. And the last thing is with respect to demand. With respect to demand, two or three things to keep in mind. One is there are people who have lost jobs. There are people who have taken salary cuts. There are people whose businesses have been impacted. So all of this will have an impact on income levels, wealth levels, etc. And because of which a discretionary category such as cars, two-wheelers, etc., is likely to see some impact. So that's the negative. The positive factor that will play out going ahead is, one, we have an easy base. So as I told you, last year was a very, very tough year. The average volume decline was 20%. On that base, it will be relatively easier to see growth. Second is pent-up demand. So when I talk about pent-up demand, it's extremely important, because if you think about it, for the last 2 or 3 months, there have been near zero sales of cars, two-wheelers, etc., or very low levels of sales for cars, two-wheelers, etc. And what it means is that it's not a case that all these potential buyers of cars and two-wheelers who would have bought the vehicle in the last 2 or 3 months have cancelled their vehicle purchase decision. That is never the case, because these are people who would have made the decision to buy a car or a two-wheeler. Not all of them would cancel. As soon as life comes back to normal, the dealerships open, production levels normalize, these people who couldn't buy vehicles in the last 2 or 3 months will come back. So pent-up demand is going to be a big factor. The fact that we have a -20% in the base is going to be a big factor. As a result, my strong view is that currently things are down. The next 2 or 3 months things will remain down because ramp up of production will be slow. Dealer ramp up, I mean, opening of dealerships would be slow. But once all these headwinds are taken care of, maybe in the second half of this fiscal, maybe starting with the festive season of this calendar, we should start to see extremely strong growth. So this is the brief background of what has happened in the past and how I see the sector. And just to reiterate, I am extremely positive on the sector from a 2 to 3 year perspective. I think the sector will see phenomenal growth in FY22 and FY23 because, as I told you, volumes are back by almost a decade. Now, with this background, let me go ahead and start answering some of the questions that you all have posted. So, some of the questions that we have received already received online. I'll just go through them first, and I'll also take some of the live questions that I'm getting on the feed. So, the first question that I have here is from Mr. Sanjeev Udeshi. And the question is, two-wheelers and four-wheelers, which segment and which companies are likely to benefit most? Now, see, if you think about two-wheelers and four-wheeler, I mean, if you think about four-wheelers, the only big name that is, present, which is a pure play on four-wheelers is Maruti Suzuki. And I have no doubt that when the recovery that I'm talking about comes through in the second half of this fiscal and in FY22 going into FY23, Maruti would be a big beneficiary of this turnaround or this recovery in the industry. And the reason is that Maruti has more than 50% market share. When I look at competition, except for one or two, names who are, extremely strong from a competitive perspective, many of the others are very small from a competitive perspective. Many of the competing OEMs have 1 or 2% market share, which doesn't pose too much of a threat to Maruti. In fact, one of the things that has been highlighted is that because of loss of income, because of loans becoming difficult, consumers are likely to downtrade to smaller cars. And I'm sure all of you know, if the consumer downtrade to smaller cars, which is the OEM that will benefit. So in four wheelers, Maruti is definitely my top pick as far as cars and two wheelers concerned. Not only from a near term perspective, even from a 2 3 year perspective. I think that's a stock that can easily go up 60-70% over the next 2 years. It's possible that in the near term, because of the fact that sales are low or volumes are weak, it may correct a bit along with the market. But if you have a clear horizon with respect to owning it for the next 2 or 3 years, this is a stock that can easily give you 60-70% returns from these levels. Coming to two-wheelers is also a segment that will do well going into the next couple of years. And here, the names that I like are Hero and Eicher. And I think both these names will give. So in case of Hero, I think a 50% return over the next 2 years is definitely possible. And Eicher can possibly give more if it re-rates because it's planning to launch new models and new platforms, etc. I will move to the next question. Now, the next question is from Mr. Tarachand Shah, and the question is as follows: can we purchase Tata Motors? Now, Tata Motors is more of a global play. I'm sure you know. 80 to 90% of its EBITDA comes from JLR, which is an overseas play, and globally, although headlines suggest that the demand situation, especially in China, is improving much faster than that in India, but I don't think that is a generalized statement that we can make for global autos as a whole. So as a result, my belief is that JLR will see sharp volume declines, maybe 12 to 15% volume declines this year, and JLR is a high cost business. It also has, I mean, Tata Motors as a whole has high debt on its balance sheet, and as a result, that's a name that I would be really careful getting into in the near term, because in the near term, I think the high amount of debt, high fixed cost, and potential volume declines will hurt its earnings. There is also some balance sheet stress, and as a result, that's a name that I would be extremely cautious buying into at these levels. The next question that I see here is from Mr. Dipen Dedia. Uh, it's as follows: how CV industries will grow in the next 10 years. Now, that's an interesting question. The reason is that CV is an industry is extremely cyclical. So, in my opening remarks, I mentioned that the heavy commercial vehicle volumes in FY21 would be lower than FY9 levels. It will be lower than the global financial crisis, and so what it means is that it's an extremely cyclical industry. So CV industry is not something that you get into with, I mean, it's not an industry where you invest in stocks with a 10-year horizon. The reason is that 10 years, you would actually see 2 or 3 upcycles and down cycles. So the smart way to play CVs would be to buy stocks. The name that comes to mind obviously is Ashok Leyland, but to buy it when things are bad. Currently, things are really bad, and from these levels, my belief is that when we see an upcycle in CVs next year and the year after, I think these are stocks. So, for example, the name that I'm mentioning here is Ashok Leyland, not Tata Motors, because Tata Motors is more global. But coming back to Ashok Leyland, I think that's a stock that can easily double over the next 2 years. Having said that, um, it's also a stock which has some amount of risk in the near term, because if you recall what I told you earlier, in case of cars and two-wheelers, I'm building in about 15% kind of a decline this year. But in case of commercial vehicles, I'm building in about 30% decline this year. And the reason is that if you look at the scenario on the ground today, about 70% of the trucks are lying idle on the road, because goods are not getting manufactured, goods are not getting transported, because of which almost 70% of trucks are lying idle. So in an environment where 70% trucks are lying idle, you cannot expect fleet operators to go and buy new trucks. And as a result, I believe that FY21 would be an extremely weak year for commercial vehicles. Having said that, the thing to keep in mind is that it's a very cyclical industry. It's an industry that you buy when things are really bad, and you sell after 2 or 3 years after the upcycle plays out. So Ashok Leyland is that kind of a stock. It's a stock that you might buy today. Currently it's about 50 rupees. You might buy today. It's possible that it goes down another 20% or so, because the near term is not going to be great. However, if you close your eyes and continue to hold that stock, I am fairly certain that it's a stock that can potentially double over the next 2 to 3 years. So it's a high return, high risk, high return stock, but that is how CV industries are, deep cyclical. When it falls a lot. So Ashok Leyland, for example, has fallen from 160 rupees to 50 rupees, and when it bounces back, it goes up 2x, 3x, etc. So that's on CVs. Not an industry which will give you a CAGR growth, deep cyclical, buy it when things are down, which is how it is currently, and exit in 2 or 3 years. The next question that I have here is from Mr. Vipul Murarka. The question is as follows: is it a good time to buy auto stocks, or should we wait for 1Q FY21 results? Now, see, that is a question which is trying to time the market, or trying to time stocks in a very, very cute manner. If you think about it, we are currently in June. We are almost at the end of 1Q. Everyone knows that this quarter volumes are going to be down 80%, 90% for most of the auto OEMs. We all know that when these companies come and report their numbers, 1Q numbers, in the month of July or August, the results are going to be disastrous. It's possible that many companies would report losses, but that is a fact that most of the investors on the street know. So trying to be extremely cute in order to time the purchase exactly around the time of the 1Q results, I mean, that's a very trying to be very smart about it. But the point is that everyone on the street is smart. So as a result, what I would advise is, don't try to time it too much. Auto is a sector, as I told you, we are, in terms of volumes, we are back by about 10 years, and the upcycle over the next 2 or 3 years is going to be amazing. And as a result, I believe that it's a sector that you should start buying now. It's possible that stocks go down from these levels, but maybe what you can do is, if you have a corpus of 100 rupees in mind, maybe buy 25 rupees today, and keep the remaining 75 rupees handy, so that over the next 2 or 3 months, because of weak results, because of weak volumes, or because of weak markets, when the stocks correct, you keep buying. So do not put in the entire corpus today. Start today, maybe with 25% of the money that you plan to buy. Do not panic if stocks fall 20% from here. Use that fall of 20% to buy more, using the 75 rupee corpus that you would have kept. And over the next 3 years, sorry, over the next 2 to 3 months, I would suggest that you should put all that planned 100 rupees in the sector, and continue to hold it for the next 2 or 3 years, because the next 2 or 3 years are going to be great. The last question that I would take from the ones that we have received online is from Mr. P.A. Nandakumar. The question is as follows: what is the prospects of investment in Tata Motors over a 3-month period? Now, coming back to what I mentioned earlier, Tata Motors is extremely high risk because 80% of the operations are outside India, and globally, although China volumes have started to rebound, most of the other geographies are still struggling. It's a company with high amount of debt. It's a company with high fixed costs. As a result, it's in that risky territory. So it's not a name that I'm recommending now. Maybe in a couple of months, when things start to stabilize, and the risk profile of the company starts to come down, it's possible that the stock would have gone up. But that's when there is a little more clarity on how the company will manage the debt, how the company will manage the high fixed cost. Maybe that's when I would like to look at it, not at these levels. Right now, the stock is up because of global headlines of normalizations, etc. But I don't think it's completely backed by earnings or completely backed by a balance sheet. What I will do now is, we are receiving a lot of questions live as we speak. So I will try and take some of the questions that have popped up on the Q&A tab. So the first question that I see here is from Mr. Prashant Bhivaniwala. The question is, would you like to talk on EV battery sector? Now, that's an interesting space. So here, while answering this question, I would also like to touch upon my broad view on the EV industry in India, or rather, EV penetration in the auto sector in India. So to start with, my belief is that EVs will take a long time to reach high penetration in India. And the reason I say that is because one is that India is an extremely cost or price conscious market. So when I say price conscious, what I mean is that Indians are extremely conscious of the amount of money you pay for buying a motorcycle or buying a car. And at the same time, India is also a small car market. Now, what happens with EVs is that if you look at the typical pricing of an EV, car that is available in India, or a EV two-wheeler that is available in India, I'm not talking about lead-acid two-wheelers. I'm talking about lithium-ion two-wheelers. The price is almost 70 to 80% more than that of a regular IC engine car or two-wheeler. And given the fact that Indians are so price conscious, I strongly believe that it will take a long time for India to see a increase in penetration as far as electric vehicles go. And a corollary to that is that EV batteries is something that will also take a long time. EVs might see some penetration in three-wheelers, etc. But in mainstream two-wheelers and in mainstream passenger vehicles, I think it will take a long time. So that's not a segment that I'm betting on. And coming to the question on batteries, since I believe that EV as a segment will take time to take off, the point obviously extends to the point on batteries. It'll take a long time for lithium-ion batteries in India to take off. And connected to that is a point that if Indian OEMs were to get into EV manufacturing, they will like to manufacture their own batteries. Like, for example, I'm sure you know that Maruti and Toyota have tied up with Denso to manufacture EV batteries. Similarly, Mahindra is planning to make their own batteries when they start manufacturing EVs on a larger scale. So EV battery to some extent would be a segment which is honored by the OEMs themselves. The next question that I see online is short and long-term view on Bharat Forge. And this question comes from Mr. Naresh Prasad Gupta. So Bharat Forge is, again, it's actually very similar to CVs. Bharat Forge is a very cyclical company. When I say cyclical company, what I mean is that its exposure is mainly to CVs, the CV sector in India, and the CV sector in the US and in Europe. In addition, they also have small exposure to PVs. They are also exposed to the oil and gas market. And currently, when I look at all these segments, global PV, global CVs, India CVs, global industrial, oil and gas, I think all these segments will go through a lot of pain. In India, as I mentioned, CV volumes are likely to be lower than the global financial crisis. In case of US, the CV production this year is likely to be, I think, a 10-year low. So when you look at all of this together, what it means is that Bharat Forge's near-term prospects, because of exposure to CVs, because of exposure to oil and gas, I'm sure you know that oil prices have fallen a lot, because of exposure to general engineering, which is also in a downturn, the revenues for this company are likely to see a sharp decline over the next few quarters. So it's a name, it's a quality name, it's a leader in what it does, and as a result, I would recommend keeping an eye on it. If it corrects from these levels, currently it's at a it's run up a lot because of the global rally. But if it corrects sharply from these levels, it's a name worth buying. But keep an eye on it. Not something that you would buy today, but definitely keep an eye on it over the next 1 or 2 quarters when things go bad and the stocks come down. That's a name that should definitely look at. The next question that I have is Mr. Saidulu, and the question is Ashok Leyland or TVS Motors good for long term? So between the two names, my belief is that Ashok Leyland would be a better investment. One, as I told you earlier, it's a part of CVs, and CVs is an industry that will do really well over the next 2 or 3 years. Of course, things are bad this year, but that's a name that you would buy a bit today and keep buying over the next 2 or 3 quarters. Whenever it comes down, do not panic and sell. If you buy it at 50, if it goes down to 40, do not panic and sell. Continue to hold it, and if it falls, buy more, because that's a name I'm sure will go closer to 80 to 100 levels over the next couple of years. TVS Motors is not a name that I'm very, very positive on because it operates at extremely low margins. Its cash flow profile is a little weak, and its valuations are really high. So it's trading at almost 30 times FY22 earnings. It's actually more expensive than Maruti. It's the most expensive auto name. So TVS is a name that I would clearly avoid. High valuations, low margins, and low cash flow generation. I have a question here from Mr. Anil Jagtiani. And the question is, what can be the reason for an upcycle in autos in FY22 and 23? So let me just repeat some of the points that I mentioned earlier. One is that autos have seen a sharp down cycle in FY20, and FY21 will also see a down cycle because of weakness over the next 2-3 months. Second half would be better. Having said that, just to repeat what I said earlier, in terms of absolute volumes, FY21 volumes would be back at FY11 or FY9 levels, for PVs and two-wheelers. Sorry, for PVs and commercial vehicles. And when volumes go down so much, it means that consumers have not been spending on that consumption category. And as a result, next year, if GDP growth bounces back, and next year, if we see income levels going up, I think it's an industry that should see a sharp upcycle over the next 2 or 3 years. I'll go to the next question. The next question is from an anonymous attendee. It says, what's your take on Maruti for the next 3 to 5 years? What's the price target? So as I mentioned earlier, Maruti is a name that I like. PVs will do really well in FY22-23, and Maruti with more than 50% market share is likely to benefit substantially. If you ask me for a 3-year target price on Maruti, I think it can easily go back to the previous high. The previous high for the stock was about 10,000 rupees, and I think that's a target that it can easily achieve over the next 3 years. Then I have another question again from an anonymous attendee. The question is, how do you see demand from rural segment, especially two-wheelers and tractors? So my belief is that rural will see much better demand compared to urban, and the reason is obvious because, and that's in the near term. The reason is obvious because urban, regions are seeing lockdowns because of the COVID issue, whereas rural markets are open. Most of the dealerships are open. Their income levels have not been impacted so much. Agri income, especially from the Rabi crop and the upcoming Kharif crop with good monsoon, is likely to be strong, and as a result, tractors and two-wheelers are likely to do well. Tractors would start reporting strong numbers immediately because there's a lot of pent-up demand in tractors. Two-wheelers, I think the year-on-year growth in volumes will start maybe with the festive season because of the other constraints that I mentioned, which is production issues. Urban, which is about 50% or 50 to 55% of two-wheeler volumes, may remain weak. So to that extent, overall two-wheeler category, even if rural is strong, may not see growth for the next 2 or 3 months. But starting the festive season, I think we should start to see growth. I have the next question from Mr. Prashant Narain, and the question is your views on Bajaj Auto. So Bajaj Auto is a name that I've liked for the last 2 years or so. Now I can answer that question from two perspectives. One is the next 2 3 month perspective, and second is a slightly longer term perspective. 2 3 month perspective, it's not a name that I would jump into immediately, and the reason is that because of the sharp run up that we have seen, from 18 1900 levels to about 27 2800 levels, I think most of the near term upside is in the price. But over the next 2 3 years, if the upcycle in autos, as I'm believing, does play out, and they also see an upcycle in volumes from Africa, Latam, etc., that's a name that should do well. They will also be a beneficiary of the rupee depreciation because bulk of their exports, they will get better realizations because of the rupee depreciation. So that's a name that I wouldn't buy at these levels because it's already done almost 50% return over the last 2 months or so. But that's a name that I would clearly like from a longer term perspective. Yeah. So the next question that I have here is from Mr. Anil Selutkar. The question is, what is the growth outlook for Motherson Sumi in the next 2 or 3 years? 2 years actually. So in case of Motherson Sumi, I think their earnings can go up 3x. So I have an EPS of 2.5 rupees for this year. That's FY21. I'm building in 5 rupees of EPS for next year. That's FY22, and my FY23 EPS would be closer to 7.5 rupees. So earnings would go up 3x. But this is also a name that has high inherent risk. When I say inherent risk, I'm talking about the amount of debt on the balance sheet. I'm talking about the amount of fixed costs on their P&L, which means that in a downturn, their earnings are likely to be hurt. But this is a name that I would keep in mind over the next, maybe post the 1Q results. So this is a name that I would try to be, a little cute with, in the sense, when I say cute, I'm talking about timing of the entry. 1Q results would not be very good, and if the stock comes back to about 80, currently it's about 93 94. If it comes to sub 80 levels, that's a name that I would buy, and I would continue to hold it for the next 2 years. And I think over the next 2 years, it's a stock that can go to 140 150 levels. I have the next question from Mr. Mihir Kumar. The question is, what is your view on related industries such as auto parts, tires, batteries, etc.? Now that brings me to my favorite subject, batteries. So batteries is an industry which I really like because of 2 or 3 reasons. One, because it's a duopoly. You have Amar Raja and Excite, two players which have 70 to 80% of the market share. Second is, this is an industry which has historically seen stable growth and stable margins. Their combined EBITDA margins have hovered between 13 to 17%, not very volatile. Very very steady. And it's an industry which generates extremely good ROC. So the ROC profile of Amaraja and Excite is about 25 to 30%, which is extremely good. in this environment where the OE volumes are likely to be weak for another 2 months or 3 months, and as a result, component guys who supply to OEMs are likely to struggle a bit for the next 2-3 months. Um, Batteries offer a good amount of resilience, and the reason I say resilient demand is because battery guys make margins on the replacement demand, and replacement sector is a sector which will do continue to do well. The reason is, if you think about it, I mean, if you own a car and if its tires are worn out, and if on one hand, and the second on the other hand, if its battery is down, I mean down as in dead, what will you change first? You'll obviously change the battery first, because without changing the battery you cannot drive the vehicle. So a battery is although it's a part of discretionary spending, it's technically not discretionary. If you have a car and your battery goes out, you don't have an option but to change it immediately. On the other hand, in case of tires, even if it's slightly worn out, you can continue driving with it for the next 2 months, 3 months, maybe even 6 months. But battery is not a decision that can be pushed out. You If it goes down, you have to change it immediately. So to that extent, in this environment, I think battery as an industry will do extremely well. There'll be very little postponement of battery purchases, and as a result, that's an industry which I like a lot. Plus, what I told you earlier, high ROCE, steady margins. In fact, lead prices have come down, so their margin should start to improve. And very little price competition between the two. So when you and the cash flow generation is extremely good. So when you look at all of this, I would definitely prefer batteries over tires. Uh, just going through the questions again. I have I think there are a lot of questions on. Oh, okay. So the next question that I see here is from Mr. Manish Walia. The question is: Ashok Leyland is a debt-laden company. How do you feel it would be a good bet for the future? So Leyland is something that I already talked about. The heavy commercial vehicles will see a bad FY21, but the growth in FY22-23 should be extremely good. And Ashok Leyland is a pure play for the category. They have about 30 to 33% market share. So that's a name that I would definitely buy. Maybe buy some today, and if it falls, buy more, because that's a name that can easily double over the next 2 or 3 years. You also mentioned that it's a debt-laden company. I don't think that's true. You might be looking at consolidated numbers. In the consolidated numbers, the debt looks high because Ashok Leyland has an NBFC as a subsidiary, which is the Leyland finance entity, in which they have about 70 share. And since that entity is consolidated, it'll look like the amount of debt on the books is very high. But for Ashok Leyland, you should be looking at standalone numbers. The debt at the end of FY20 should be about 2,000 crores. Their equity is closer to 7,000 crores. So debt to equity is not at all alarming. So that's a name that has very little balance sheet risk. So that's a name that I would continue to recommend. But don't jump in all in immediately. Buy some at 50. Be conscious of the fact that it can go down a bit, but if it goes down further, buy more. Do not panic, do not sell if it goes down. If it goes down, buy more, and over the next 2 years, I think it can go closer to 80 to 100. The next question is from Mr. Suhas Ingle. The question is expectations from government auto policy, when is expected to be declared. On this, couple of things that a couple of policy decisions that we have been waiting for are: one, a scrappage policy which the government has been talking about for the last 4 years or so. We are still waiting for it. If that comes through, there might be some short-term benefit to the industry. The second is the entire industry over the last 1.5 years has been calling for a GST cut, but that is not something that has come through. My estimate is that auto industry contributes about 1 lakh crores in the form of GST, and this is only the new vehicle sales that I'm talking about. And that's a big number. So if they cut, given that government's fiscal scenario is not that great, it's possible that they might not take that decision in order to save the fiscal scenario. But that's a point that most of the OEMs have been asking for. But we are still waiting for it. If it comes through, it will be amazing because vehicle prices will go down. For instance, if the base rate for autos, which is currently at 28%, if it is cut to 18%, we might see vehicle prices coming down by about 7 to 8%. And if that happens, that will definitely increase affordability for the auto sector, and that will be a good driver as far as volumes go for the next 2 or 3 years. So that was the last question for the day. And what I will do now is I'll just sum up the points that I have made over the last 40 minutes or so. To sum up, one, we saw an extremely weak FY20. FY21 is also likely to be weak. I expect an average 20% volume decline this year. Last year was also a 20% volume decline. However, the positive is that if after 2 years of about 20% decline, the auto volumes would be back by almost 10 years. As I said, PV volumes would be back at FY11 levels. CV volumes would be back at FY9 levels. And as a result, the outlook for the sector for the next 2 to 3 years, starting FY22 to maybe 23, 24, is going to be extremely good. As a result, this is a sector that you should absolutely buy into. Buy some today. When I say today, what I mean is, buy some at current levels. Do not buy the entire, planned investment at current levels, because the next 2 or 3 months are likely to be challenging. But we don't know how to time it. So maybe buy 25%, immediately. Do not panic if the stocks go down. If the stocks go down, continue buying. And over the next 2 or 3 months, I would say deploy the entire planned investment in the sector and continue holding it for the next 2 or 3 years. I think the returns are going to be good. In terms of specific stocks that I like, just to reiterate, in passenger vehicles, it's obviously Maruti, 51% market share. I think over the next 3 years, it can go closer to 10,000, which is the previous peak. The second name is Ashok Leyland. Ashok Leyland will have a tough next couple of quarters, but buy some today, buy over the next quarter or two, and continue to hold it, because that's a name that can easily double, go closer to 80 to 100 rupees over the next 2 years. In two-wheelers, that are the names that I like are Hero and Eicher. And coming to the auto component side, I like the batteries, which is Amar Raja and also Excite, but more Amar Raja over Excite. And I also like Motherson Sumy. Motherson Sumy and Bharat Forge have a good amount of global exposures and cyclical exposures, especially in case of Bharat Forge. So with the next couple of quarters are going to be tough. So I would ask you to time your purchases better on those names. Don't buy immediately. Maybe over the next couple of quarters, if the stock weakens and fundamental and some because of weakness in revenues, earnings, etc., buy it at lower levels. Buy Motherson maybe sub 80 levels, buy Bharat Forge sub 300 levels. So this is the sum and substance of it. Thanks a lot for logging in. It was very good chatting with you all, especially the interesting questions that came online. And thanks a lot for that. And for more details, you can please write to us at research@iifl.com, or you can visit our website, that is www.iifl.com. Thanks a lot. Have a good day.